Hello, this is Jim Ammerman, Managing Director of Wealth Planning at Fortress Wealth Management. And I'm going to talk to you about cryptocurrency and Bitcoin taxes, and then how Puerto Rican residency can affect those taxes and your other capital gains tax situations as well. So since our lovely Staples Center in LA has been renamed Crypto.com Arena, I thought that was a sign that it's time to make a quick video on crypto taxes. The IRS website says virtual currency that has an equivalent value in real currency or that acts as a substitute for real currency is referred to as convertible virtual currency. And Bitcoin is one example of this. So let's take a look at how the gains are calculated. When you sell virtual currency, you must recognize any capital gain or loss, which is the difference between your cost or tax basis, i.e. what you paid for it, and the amount you received from the sale less any fees. If you held the virtual currency for 1 year or less before selling or exchanging, then you will have a short-term capital gain or loss subject to federal tax rates from 10% to 37%, plus your state's income tax. If California is your state, then you're looking at 9.3% or less for most of you as an additional tax, but it could be as high as 13.3% for those with high income. The holding period for your virtual currency begins on the day after your purchase and ends on the day you sell or exchange it. If that period is more than a year, that gives you access to long-term capital gains rates rather than short-term. And these rates can be 0%, 15%, or 20%, depending on your taxable income level. And additionally to that, if you have high modified adjusted gross income, so over 200,000 for single or 250,000 for joint, married filing joint, then that could trigger an additional 3.8% net investment income tax on top of that. These rules can be used to reduce your long-term total tax bill over your lifetime by applying quality tax planning that looks at the future estimated income and applies analysis to finesse the timing of when gains are recognized, which is also referred to as gain harvesting, if you've heard that term before. Alternatively, tax-wise, if you live in Puerto Rico for at least 183 days per year and can claim residency status, then appreciation that occurs while you are a resident can avoid long-term capital gains tax. Be aware that your prior state of residence may still try to tax you after you move to the island. California especially, they apply many hoops to apply before they will release you from their tax claims. And the burden of proof falls on you, unfortunately. But there's another nice Puerto Rico bonus that can make it worth it. If you have been a resident of Puerto Rico for over 10 years, then you can also avoid long-term capital gains tax on the appreciation that occurred before your Puerto Rico residency. Many people think that their current and past appreciation can be tax-free if they move to Puerto Rico, but that requires a 10-year commitment. You got to stay there 10 years. So hopefully you like plantains. So record keeping, the IRS requires records sufficient to establish the positions taken on tax returns. And you want to keep these records for 3 years. You may receive a 1099 from your broker, your crypto broker, that shows a gain amount that doesn't reflect the true cost basis. And this is going to be, I think, more common than it would be for non-crypto assets. So it's even more important that you keep your own accurate records so you can reconcile any differences. If you have any questions, feel free to send me an email. It's jim@fortress-wealth.com. And I also welcome you to check out my tax reduction planning videos on this Fortress channel as well. Thank you for your time.